Welcome to the Times of Industry show. We are hosting Ronald Stofferle today for part two in our In Gold We Trust series of interviews. One of the world's top precious metals analysts and fund managers is with us today. We got so much feedback regarding our first interview together that we're putting together this part two today. As we're doing the interview, gold is experiencing a test of a lifetime. It's trading right below 1,300 again, and it's trying to push up towards the new 52-week highs that we saw in August. Ronald, how are you today?
Many thanks, Lee, for inviting me back to the show. I'm doing very good. Excited to publish a very, very good chart book on gold again. And yeah, looking forward to our interview now.
From this chart, it looks like the gold companies have done a pretty good job overall of cutting costs, which is what the CEOs can control, becoming more efficient and more profitable as early as 2014. Personally, my own belief is that after 2 years of intense research in the new junior mining space, speculative money, the types of money that propels these stocks into higher levels, is just not there right now. The positive numbers are important, but for a 2009 to 2011 type returns, the S&P 500 has to look much less attractive. Bonds have to continue being negative to zero, and the volatility and fear of trouble has to play a part. But as that happens, I think this coming move will be so epic that even if you're sitting on a 50% paper loss today, as long as the company is genuine and bulletproof in terms of debt levels and cash levels, it will surpass its 2015 to 2017 prices very easily. That's a long way of asking, Ronald. Do you agree, or do you think that stocks, gold mining stocks, silver mining stocks, etc., will continue to disappoint?
Well, that's really a long question. Let me give you my few thoughts on the mining space and on the gold mining space in general. I think that we have seen, due to this more than 4-year-long bear market, we have seen some major creative destruction, as Schumpeter would have called it. So from my point of view, the companies, they really did their homework, and now the majority of gold producers rests on a more solid fundamental basis than ever. So we have seen the companies, they are leaner now, they have reduced their debt burdens, they kind of ensured that they will benefit to a greater extent from a rally in gold prices. And let's not forget, last year, the first half of 2016, we have seen gold gaining 28%, but the mining stocks, the gold stocks, they rallied by 180%. So from my point of view, due to this creative destruction, we are seeing a much more asymmetric return potential, and I think that gold stocks offer a higher leverage on rising gold prices now. So, from a fundamental basis, or from a fundamental point of view, I think mining stocks are extremely interesting, and we should not forget that the confidence in the mining sector is very, very low. So we're seeing a tiny market capitalization. We talked about that in our last interview. And we are seeing that the majority of investors was really disappointed with the performing of mining stocks. So going forward, I think the industry really has to continue to deliver on the promises that they made in recent years, and they have to really keep working on rebuilding investor confidence. I don't know if you followed that, but John Paulson wants to put much more pressure on the management of mining stocks, and I think that's a very good effort and a good idea. And there's plenty of other fund managers and investors that will join John Paulson. So coming back to this chart that you're showing, we can see that that in 2012 and 2013, most of the basically the whole HUI index, the gold box index, HUY, generated a significant negative cash flow. But this has brightened considerably. So at the moment, so last year we have seen total free cash flows at roughly 5 billion, which is much more than the previous record high of 2011 when gold was trading at 1800 or even 1900. So even though the price of gold is significantly lower, companies are generating much more free cash flow than in the record year of 2011. That's a very, very good sign. So going forward, I think one really should try to avoid investing in companies with the habit of diluting their shareholders by flooding the market with new share issues. We should really focus on companies generating free cash flow with high reserves per cash, with earnings growth per share. Those are, from my point of view, the most important financial metrics. Of course, we have to consider political risk and so on. But to sum up, to give you a long answer to a long question, we are very, very, very excited about the mining space at the moment. We are focusing on developers and on emerging producers. I think that's the sweet spot. And I would say that if my assumption is right, that we're at the beginning of a new bull market, then silver should outperform gold actually. And then silver mining companies that nobody cares about at the moment should do even better than gold mining companies. So I think it's a great entry point.
Now, Ronald, this is a fascinating chart because it really makes the case that inflation has to do more with psychology than fundamentals. It just erupts as the public loses faith in the currency's power and stability. Is this realistically what we should expect going forward? Much more inflation and much less stability with the with our most stable economies?
Well, I think that when it comes to gold, I think there's one word that is very, very important, and this word is trust. So it's no coincidence that our reports are called "In Gold We Trust." And what you can see on this chart is the relative scarcity of gold versus fiat money versus money that is created by central banks. So Dave Rosenberg, an economist that I greatly respect, he said it's all about relative supply curves. The supply curve for bullion is far more inelastic than is the case for paper money. It really is that simple. And I totally agree with Dave Rosenberg. So what you can see on this chart is the annualized rate of change of central bank balance sheets versus annual change of gold reserves in the years 2003 to 2017. And you can see that basically the inflation world champion is the People Banks of China. So on an annualized basis, their balance sheet grew by 40% every year since 2003. The S&P, the Swiss National Bank, is on the second place with 39%. And then comes the Fed, Bank of England, ECB, Bank of Japan, and then gold. So the annualized rate of change, so the annual inflation, if you want to put it that way, of gold is 1.48%. So the ounce of gold that you hold is basically inflated by 1.5% every year. And that's, I don't know if it's a coincidence, that's pretty much the same like population growth that we're seeing nowadays. And the most important thing to know is you cannot inflate the stock of gold by will. So it is, at current prices, it's basically impossible to produce like 100% more gold every year, which would be 6,000 tons. But still, if there would be some new technology and it would be really more efficient to mine gold now, if production would rise to 6,000 tons a year, this would make the annual inflation of gold still at relatively small 3%. So if you compare that to the inflation of fiat money, it's still ridiculously low. And that's, from my point of view, the most important thing. Governments, central banks can basically inflate their balance sheets without any limits. With gold, due to its stock to flow ratio, this is impossible. So this is all that one really has to know about gold. Mind the stock to flow ratio, and this clearly shows you why people still have so much trust in gold and why gold cannot be treated like a soft fiat currency.
Ronald, regarding gold shares again, this chart really highlights that the bull market at this point has been like a turtle head, just popping out to daylight for an instance and then returning back to the shade. Personally, I have put significant amounts into my favorite names. I'm expecting gains in the thousands of percents in the next 3-4 years. Am I being too bullish?
Well, I like the term like a turtle head popping out to daylight. I think this is a great wording. What we're seeing on this chart is something that I'm doing every year now. I'm just showing the bull markets in the Barron's Gold Mining Index, which is the mining index that is available since 1942. And again, if my assumption is right that we're in a bull market for gold and mining stocks, then it clearly shows you that this bull market has much room to go further, not only in number of weeks, but also in times of performance. Is this bull market still very, very small? So you can see on this chart that every time at the end of the trend, the real euphoria kicks in. So this is the phase when you've got those really huge returns, which within a very short time frame, and you can see that we're far away from that now. So I think that Jordan Roy Byrne, who is an analyst that I greatly like, he said that the current market is a bit like a bearish bull. So there are some things that kind of worry me, but we should not expect too much from gold at the moment, because we're seeing rising rates. We're seeing that the stock market is still doing very, very well. We see that there's so much complacency in the market. We're seeing that volatility is extremely low. So we're seeing lots of headwinds for gold. But the tides will turn, that will change. And some of these headwinds will become tailwinds. And this is probably going to be the time when the mining stocks and gold itself really pick up momentum. I'm not sure when this is going to start, but based on my analysis, also in the chart book that we're presenting tomorrow, we can see that the risk-reward ratio of mining stocks and gold is just enormously attractive at the moment.
Now, I've said this time and again, until buying Apple or Facebook doesn't make any sense, institutional investors will keep favoring them over gold assets and mining shares. My analysis has been that as the economy grows, at the same time as the stock market corrects, the time for gold stocks is best. That's when we see higher oil prices as well. It looks like Europe and many parts of Asia are growing. Some areas of the US show positive growth. Is a commodity supercycle starting? What do you think?
Yeah, well, I think that the commodity sector itself, it made its lows in 2016. We have seen a brutal bear market, and I tend to say, I mean, that's an old saying. The the bear market is the foundation for the next bull market. So from my point of view, we are seeing very, very attractive levels for quite a lot of commodities. For instance, I'm due to the geopolitical situation as well as the demand structure. I am much more confident on oil compared to many other analysts. So if you walk into a room and ask 100 analysts where's the oil price going to be for the next 3 to 5 years, I'm absolutely sure that probably 99% will tell you, well, price of oil will be between 45 and 55 for the next few years. So that's a very, very strong consensus. And I can make the case for significantly lower oil prices, but I think that due to OPEC and Russia at the moment, due to the Saudi Aramco IPO coming in a couple of months, due to the geopolitical situation, what's going on with Iran at the moment, also the tensions with North Korea. I think that oil might be spiking up big time, and nobody is seeing oil at 80 or even 100 going forward. So in general, I think the commodity space is a great buy at the moment. And I think that one can also make the case for commodities doing really well in case growth is actually quite sluggish. Um, let's remind ourselves of the big stagflation in the 1970s. We have seen quite anemic growth in the 70s, but people were losing confidence in the role of the dollar. They were losing trust in the dollar. And this is the reason why, first of all, gold rose big time, or you can say the dollar devalued versus gold. And also, this is one of the most interesting press releases in history, probably. Quite soon after President Nixon announced the end of the Bretton Woods Agreement in August 1971, OPEC said, due to the new monetary regime, we have to reconsider our pricing. So basically, this was just saying, okay, we don't trust in the purchasing power of the dollar anymore. So oil prices will rise in dollar terms. And I could really see that going forward, people will be losing trust in paper currencies again, and that paper currencies will devalue against hard assets, especially commodities, going forward. And in fact, this is something that we might be in the beginning stage of. Now, having a look at this chart, the Philadelphia Gold and Silver Index versus the S&P, it shows you that basically the ratio stands at the same level as in 2001 when gold was trading at $300 and the great bull market had just begun. So from this metric, you can see that mining stocks relative to the S&P are definitely attractive. But we should not forget that, of course, mining stocks, they also include lots of equity risk. So in the case of a general market crash, I would not expect that mining stocks could decouple right away. So I think they would be having a hard time, at least at the beginning. But as soon as gold rises afterwards, I think gold stocks should be doing very well. But people should not forget, in case of a general crash in equity markets, this also affects mining stocks, of course.
Lastly, the connection between higher rates and recessions needs to be discussed. When borrowing costs rise for both consumers and businesses, layoffs begin, margins contract. If before the business relied on artificially low rates, then after they're not artificially low anymore, it just looks to me that many companies in the US cannot survive a 2 or 3% interest rate on the federal level, let alone the government level. Is the next recession near, or will the US be able to rise above this by reforming its tax plan? Will that be enough?
No, it won't be enough. I think that President Trump will have a hard time implementing the tax cuts, so I wouldn't expect too much from that, honestly. In our last In Gold We Trust report, we were actually making the case for a recession. And don't get me wrong, nobody is talking about the US recession at the moment. I think we discussed it in our last interview. So we should not forget that we're already in the hiking cycle. Basically, when Ben Bernanke announced his tapering, this kind of soft exit from the QE program in mid-2013, this is when the tightening mode basically started. So we're quite a while in this tightening cycle. And of course, we have in the last couple of months, we have seen rising rates, still at a very slow pace, but the market expects that rates will continue to rise. And we know that due to the Austrian business cycle theory, due to the general debt situation, not only for governments, but also for companies, also for private people, for basically everybody, due to the very low rates, is massively over indebted. And the higher the debt, the higher the consequences or the fragility in times of rising rates. And what you can see on this chart, this is definitely one of my very favorite charts, is we're seeing rate hike cycles and following recessions in the US. And this chart goes back to 1914. So the historical evidence is overwhelming. In the past 100 years, 16 out of 19 rate hike cycles were followed by a recession. Only 3 cases turn out to be this exception to the rule. So I think making the case for a recession in 2018 or 2019 is not such a bold call from my point of view. But still, based on Bloomberg consensus, no general economist is expecting a recession going forward. Now, why is that important for us as investors in the gold space? It's important because the market, especially equity markets, they expect that the economy will continue to do pretty well. Companies will continue to show higher sales, higher earnings. Everybody is expecting that we'll see a couple of more rate hikes. But what's going to happen as soon as the bad R word, the recession that everybody will be freaking out about, if that really starts to come in? Of course, there will be consequences. There will be interventions from central banks. They will definitely very, very quickly announce that this rate hike cycle is over and that they will lower rates again. There will be something like a next round of quantitative easing. Perhaps they will call it QQE like the Japanese do, so quantitative and qualitative easing. Perhaps the Fed will start buying equities like so many other central banks do nowadays. And there will be fiscal stimulus. So this is the reason why gold reacts really positively to recession fears. Because it discounts that central bankers and politicians will intervene big time. So from my point of view, this will exactly be the point when gold picks up momentum. As soon as the market realizes that the emperor has no clothes and that stocks, real estate and other asset classes will start feeling headwinds, this will be the moment when gold will start getting tailwinds and when it really will pick up momentum.
Ronnie, thanks again for doing this interview. Can you tell everyone where they can find the new gold chart playbook?
Yeah, sure, of course. It's on our webpage, incrementum.li. We've got a journal where we're posting this chart book on gold. So this is basically an update of our In Gold We Trust report with the most striking, most interesting charts that we're having at the moment, also with some small comments. So you can download it for free on our webpage, incrementum.li, or on the webpage that is dedicated to our In Gold We Trust report. It's ingoldwetrust.li, LI, which stands for Liechtenstein.
Ronnie, thank you very much for taking the time here. It's been a real pleasure. We'll have the link at the description of this video, and we will welcome you again in the future.
Thank you very much, Leo. It's, as always, been a pleasure. Take care, my friend.
Thank you.
Thank you.
And we're off the air. Hey, Ronnie, thank you very much.
Thank you. Enjoyed it, as always. Thank you very much, Leo. Have a good day.
I'll send you an email 1 week before I'm in Switzerland. If this works out, we're very well.
Excellent. Excellent. Take care.